Welcome to Bodhi Unified Flow, where we simplify complexity and amplify performance. Today, we are diving deep into our explainer for topic 8, life and health insurance, and specifically, protecting your family from the absolute risk of the unknown. It's actually kind of funny. We insure our cars, our phones, even our basic appliances almost without a second thought. But when it comes to our absolute greatest asset, ourselves and our own earning potential, we just leave things completely exposed. Today is all about changing that mindset. We're going to build a non-negotiable financial safety net to make sure you and your loved ones are truly protected. Here is our roadmap for today. First, we'll tackle the risk of the unknown. Then we'll hit life insurance essentials, followed by health insurance fundamentals. After that, we'll navigate the claims process, go over some critical mistakes to avoid, and wrap up with a summary and our references. So, what's in it for you? Well, by the end of this session, you're going to be able to completely dismantle those stubborn insurance myths, calculate the exact coverage your specific lifestyle actually demands, navigate hospital claims without breaking a sweat, and avoid those fatal mistakes that can literally destroy wealth overnight. All right, let's jump straight into part 1, the risk of the unknown and overcoming this dangerous illusion of permanent health. There's this huge behavioral trap that catches so many of us off guard, right? It's the illusion that we're always going to be healthy. To really ground this, let's look at a number: 8 lakh rupees. Our sources share this incredibly jarring story about a 25-year-old. Young, fit, had some routine stomach pain. Well, that minor issue escalated instantly into emergency surgery and a 10-day hospital stay. The final bill? A staggering 8 lakh rupees. Because he was operating under that illusion of permanent health, he didn't have health insurance. That single, totally unpredictable event completely wiped out years of savings, drained his emergency fund, and threw him straight into serious debt. And if you're wondering why a hospital trip hits so hard, look at this number: 15%. That's the rate of medical inflation here in India right now. It means the cost of treatments is basically doubling every 5 years. So a standard 2 or 3 lakh policy, that simply won't cut it anymore with costs compounding that aggressively. A catastrophic health event isn't just a medical emergency, it is a direct, aggressive threat to your long-term wealth. Moving on to Section 2, Life Insurance Essentials. Let's look at the mathematical basis of protection. Okay, we need to completely shift how we look at this. For breadwinners, life insurance, it's not an emotional decision. It is a mathematical necessity. There's a concept called human life value, or the HLV method, and it treats your future earning potential as a tangible asset. Basically, you take your annual income, subtract your personal expenses, because, your family wouldn't be paying for your daily commute or hobbies if you were gone, and then multiply that figure by your remaining working years. It is an incredibly useful formula, especially for ambitious professionals, because it accurately pegs the total economic loss your family would face. Now, if you want the absolute gold standard, you go with the needs-based analysis. This one's the whole shebang. You sum up all your future financial obligations. We're talking daily living expenses for your dependents, your total outstanding debt, and big milestones like a kid's higher education. Once you have that massive number, subtract your existing liquid assets, and whatever is left over, that gap is your exact insurance need. But hey, if running complex formulas isn't your thing, there is a much simpler rule of thumb that financial planners love. Just maintain a life cover of 10 to 20 times your annual income. So if you're making 15 lakhs a year, you need to be looking at an absolute minimum cover of between 1.5 to 3 crores. The experts in our sources are absolutely emphatic about one thing: never ever mix your investments with your insurance. Stick to term insurance. It's a pure risk cover. You pay a relatively small premium and you get a massive payout in the event of a tragedy. If you survive the turn, no, you don't get the money back, but that is exactly the point. It's an expense to protect against catastrophe, not an investment. On the flip side, things like ULIPs, which mix insurance with market investments, almost always give you severely lower life coverage, much higher premiums, and really subpar returns thanks to all the hidden fees. Keep the two entirely separate. Section 3, Health Insurance Fundamentals. This is all about protecting your assets from the morbidity trap. So life insurance replaces your income, right? But health insurance, that acts as a vital shield for the assets you've already built. Let's look at how to optimize that shield. First, make sure you have a cashless hospitalization network so you aren't forced to drain your bank accounts paying massive bills up front. Next, look for restore or refill benefits. These actually replenish your sum insured if you exhaust it in a single year. Then, you've got super top-up plans. Guys, this is a total game changer. It's a deductible model that massively increases your coverage for a fraction of the cost. Think of it like a secondary safety net for your primary safety net. Finally, consider critical illness riders. They give you a lump sum payout if you're diagnosed with a serious disease, helping you cover lost income during recovery.
Now, brace yourself for this one. 83%. That is a terrifying statistic. In India, roughly 83% of our senior citizens have absolutely no health coverage. None. With medical inflation soaring, this leaves families structurally vulnerable, often forcing adult kids to literally liquidate their own retirement savings just to fund their parents' healthcare.
So how do we actually protect our older parents? Well, our sources mention a story about a 65-year-old uncle who suddenly needed a stent, and it perfectly underscores why we have to act fast. You can look into family floater plans, but heads up, the pricing is usually tied to the oldest member's age. And expect what insurers call loading charges, basically higher premiums if they have pre-existing conditions like diabetes. Also, read the fine print on copayment clauses, where you have to pay a fixed percentage of every single bill yourself. Oh, and definitely look into the Ayushman Vandan scheme. It's a government initiative that provides 5 lakhs of free health cover for anyone aged 70 and above, regardless of income. All right, let's get practical. Section 4, navigating the claims process, from pre-authorization to final settlement. Look, buying the policy is only half the battle. Knowing exactly how to use it is what counts. Here's the play-by-play for a planned cashless procedure. Step 1 is pre-authorization. You have to inform the hospital's insurance desk 48 to 72 hours before the surgery so the insurer can give the initial green light. Step 2 is admission. Don't be surprised if the hospital still asks for a token cash deposit just in case of non-medical expenses. And step 3 is discharge and final settlement. The hospital sends the itemized bill to the insurer, and you literally have to wait there in your room until the insurer clears it. The hospital's insurance desk is your crucial middleman for this whole thing. This brings us to a massive difference, using a cashless facility at a network hospital versus the reimbursement process at a non-network one. Cashless is smooth. The insurer and the hospital just talk to each other and settle it. Reimbursement? That is a headache. You pay for everything up front, collect every single original bill and lab report, and then hand over a massive physical file to the insurer weeks later. And here is a critical warning straight from the sources. Watch out for blacklisted hospitals. Even if you plan to pay cash and get reimbursed, if that specific hospital is blacklisted for past fraud, your claim will be rejected, period.
Section 5, avoiding critical mistakes. Because we really need to secure that safety net.
You can have the best plan in the world and literally void it by making one of these mistakes. Let's rapid fire through them. Number 1, lying on your proposal form. Do not hide pre-existing conditions or the fact that you smoke. It is a guaranteed way to get your claim rejected when you need it most. Number 2, the procrastination tax. Waiting until you're older to buy insurance just means volunteering to pay insanely higher premiums for life or risking becoming uninsurable altogether. Number 3, ignoring the insurer's track record. Fancy features mean nothing if the company aggressively denies claims. And number 4, assuming your corporate employer insurance is all you need. The second you leave that job or start a business, that coverage vanishes. Which brings us to a bit of a harsh reality check. Honestly, ask yourself right now, is your family's financial future built on a true, mathematically sound safety net? Or are you just relying on this fragile illusion that you're never going to get sick? It's a tough question, but we have to challenge our own complacency here. The stakes are simply too high to leave to chance. Seriously, don't wait another year to run these numbers.
Finally, Section 6, summary and references. Building the foundation of financial resilience.
Let's bring it all together and close the loop. We set out with some clear goals today, and here's what we've locked down. We've totally dismantled that procrastination tax and shattered the illusion of permanent health. We mastered how to calculate what you actually need using the HLV formula, and we know exactly why term insurance beats mixed products hands down. We learned how to build a fortress around our assets using super top-ups, and we demystified the cashless claims mechanics so you're never caught off guard. Remember, at the end of the day, insurance is a foundational living expense, not an investment. And here are the references that powered today's explainer, pulling from some excellent foundational financial guides and transcripts. Thanks so much for joining me on Bodhi Unified Flow today. Take these frameworks and apply them. But before you close out, think about this. If the unknown knocked on your door tomorrow, would your family be saying, "Thank goodness we planned," or would they be staring down a complete financial disaster? Protect your wealth, and I'll see you in the next one.